that I emailed you yesterday, so you have no idea what I'm talking about. Okay, so let me set the table before we kind of look at what to do. As I said at the end of the last class, this is a cash flow exhibit used on an actual valuation of a target company. Okay? The acquiring company was a company called Kennecott, which is a copper mining company, which actually got into this pickle because they were forced to divest themselves of a coal mining subsidiary. The antitrust laws kicked in. They had to sell the subsidiary. They got $600 million in cash when they sold the subsidiary, which created a problem for Kennecott. The problem was they had cash. They had nothing to do with the cash. You see, that's a nice problem to have. What were they worried about? What's the problem with having a lot of cash on your balance sheet? What were they concerned might happen to them? They were concerned that they would be acquired by somebody else. So I'm going to ask you two questions. You're a company, in this case Kennecott. You have $600 million in cash for which you have no use. What's the most logical way to get rid of cash for which you have no use? Give it back to shareholders. That thought never even crossed their minds. So what would shareholders do with it? Stupid things like pay off mortgages, pay bills. We can't do that. What's the stupidest and quickest way to get rid of $600 million? Acquire somebody else. So here's what Kennecott did. They went to First Boston, at that time the leading M&A investment bank on the street. And they said, look, we have $600 million in cash. We really want to spend it quickly. Can you help us? It's like walking to Bloomingdale's, waving $5,000. I have to spend it by 4 o'clock today. Can you help me? They work on commission. You're going to be surrounded by salespeople for the rest of the day. First Boston said, no problem. We'll find you a perfect target. And a couple of weeks later, they came back with a target. The target company they came back with was Carborundum. So Kennecott says, how much will this cost us? And First Boston said, coincidentally, it will cost you exactly however much cash you have on your balance sheet. Another rule in acquisitions. The target company's value will rise to the amount of cash available to spend. And then they backed up that statement by saying, look, we've done a valuation. You're going to be paying $550 million, but you're going to be getting back more than that in value. And here are the cash flows to back it up. So this is the table used to back up that recommendation. Incidentally, I pulled this out of a Harvard Business School case study, where this became another strategic case. I mean, everything in Harvard becomes a strategic case. This exhibit was not meant to be the centerpiece. What students were supposed to debate was, did Kennecott buy the right company? All the strategic fit issues, which I think misses the point. It misses the point because at the right price, you can buy any company. At the wrong price, I don't care how great the fit looks, it is the wrong company. So they gave away the game with these cash flows. So here's the question I'd like you to, how many of you are planning to go into M&A, even in some mythical investment bank, even if you haven't gotten exact M&A? Okay. This is a good test for you. What I'd like you to do for me is, if you fail this test, please look for a different pathway. Because this is a deadly test to fail. It can cause billions of dollars in damages to companies. Okay? So let me go through how they estimated cash flows. I mean, we can debate details. I don't even want to make a question of, did they use 10 times earnings to get a terminal value, which is a terrible way to do it. Let's act as if all the numbers are okay. Let's look at the mechanics of what they did, okay? So they started with net income. So I'm going to describe what they did. What I'd like you to think about is, first, are these cash flows to equity, which are after interest payments, after debt payments, or cash flows to firms? So that's, for the moment, think about that as I describe what they did. They started with net income, with all kinds of little assumptions along the way. From the net income, which is what that line item is, they subtracted out only the equity portion of their reinvestment. So remember that see this total capital added? That's for the total reinvestment, but they're subtracting out only the equity portion. So in year one, they're taking the net income, subtracting out the equity portion of the reinvestment, 0.1 million, coming up with the cash flow that year. So what they call dividends is really net income minus equity reinvestment. Okay. So here's my first question for you. We have a cash flow line item here. This is basically the heart of the analysis, these cash flows. Are these with those cash flows, I'm going to show you 4 different discount rates, and the question I'd like you to address is, which of these 4 discount rates is the right discount rate to use, given what we said about consistency, given how the cash flows are computed. Okay? Here are the 4 discount rates. There's Kennecott's cost of equity, Kennecott's cost of capital, 13% and 10.5%. Carborundum's cost of equity, Carborundum's cost of capital. First, should I be using cost of equity or cost of capital? Really, the question I'm asking is, are these cash flows to equity or cash flows to the firm, right? How can you tell? You have a 50-50 shot, actually, when you think about it, right? But there is a much more effective way, a much more logical way to do it. How did I describe cash flows to equity? The cash flows after debt payments, right? So that's all you need to look at. Are interest payments being subtracted? Are principal payments being subtracted, right? And if they're raising debt, is that showing up as a cash inflow? If it is, then it's a cash flow to equity. We're starting with net income, right? Net income after interest expenses or before interest expenses? Net income is after interest expenses. Here's a dead giveaway. When you look at a table of cash flows as to whether it's an equity cash flow or a firm cash flow. If you see the table starting with operating income or operating income after taxes, then it's generally a cash flow of the firm, though people do mangle all kinds of stuff. So if your starting line item for income is operating income, then it's usually a cash flow to the firm because you're not subtracting out interest expenses. If your starting income line item is net income, it's usually cash flow to equity, though some people add back the interest expenses to check for that. In this case, they're not adding back interest expenses. They're actually subtracting out the extra interest expenses to come up with net income. So this is classic net income. So it's earnings after interest expenses. They're counting cash flows they get from debt as positive cash flows. See this 140 million? You're saying, where did they come up with that money? What is that 140 million? That's actually debt they're going to raise to retire equity. It's a cash inflow from debt. So they're counting cash flows from debt either as positive cash flows or negative cash flows. So the cash flow you're ending up as a bottom line here is a cash flow to equity. So the discount rate has to be cost of equity. So you can actually cross out those. A cost of capital is inappropriate as a discount rate if the cash flow you're discounting is a cash flow to equity. Now let me ask you the tougher question. You got the cash flows now, right? For carborundum, whose cost of equity should I use to discount those cash flows? Kennecott's cost of equity or carborundum's cost of equity? Okay, let's see a show of hands. I heard a few Kennecotts, I heard a few carborundums. How many of you think I should use the acquiring company's cost of equity? Okay. Why? Give me a reason, either of you. Collectively, you can give me a reason. Why the acquiring company's cost of equity?
Because I have to value against my shareholders' cost of capital.
Okay. So you have one cost of equity for everything you do? You have one cost of equity then for everything you do, right?
Yeah.
What if I came to you with an investment that makes 5.5%? You turn it down flat? That's well below your cost of equity, right? What if I told you the investment was guaranteed? So you just broke it. I mean, in a sense, it's not the cost of equity to your shareholders, it's the cost of equity of the investment. You're looking at a riskless investment, you should use the risk-free rate. This goes back to capital budgeting, right, in corporate finance. What do we say? The discount rate for a project should reflect the risk of the project, not the risk of the entity taking the project. If it were the latter, for safe companies, everything should look like a bargain, right? Because they're bringing in a low cost of equity. Never, ever, 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 hope I'm not leaving any wiggle room here, ever, use the acquiring company's cost of equity to value a target company. No excuses, no exceptions, no, can I do it here, can I do it there? Never. It should always be the target's cost of equity. Or cost of capital, depending on whether you're looking at cash flows. So in this case, the discount rate they should have used should have been 16.5%. First Boston, leading investment bank in terms of M&A deals in 1979. Guess which discount rate they used? What's the worst possible answer you could give me? What's the furthest away you can get from the truth?
You would have given used the cost of capital to get 600 million.
Wrong company, wrong discount rate, right? Now we could say, well, they knew what they were doing, and maybe they just went for the lower discount rate. I don't think so. I don't think they knew what they were doing. You're giving them too much credit. I think they screwed up big time. They didn't even think about what discount rate to use, because one team was working on the cash flows. They came back with the cash flows. The other team was working with the discount rates, and the two essentially came together at the last moment, and you see the consequences. So here's the only thing I'm going to change. I'm going to take their cash flows. I'm not going to contest a single assumption. I'm going to take everything they assume and say, okay, let's assume you're right. But I'm going to discount back at the right cost of capital, 16.5%. Remember they paid $550 million? First Boston told them it was worth 600, 650, 700 million based on 10.5%. With their cash flows and the right discount rate, the present value you get for those cash flows is about 450 million. So what have they done? They've advised Kennecott to pay 100 million more than their own cash flows are telling them this company is worth. I use this for two reasons. One is, don't be dazzled by the name on a valuation report. Smart people can do stupid things. Just because you see a Goldman Sachs, a KKR, don't assume that they've done everything right, that the first principles. You'll be amazed at how often you see first principles violated in valuation. And this is a first principle violation. The way I describe it, there are some issues in valuation where we can disagree. Here's one. You think your company will grow at 20% for the next 10 years. I think it'll grow at 10%. That's a debatable issue. This is not a debatable issue. This is a first principle that's being violated because cash flows and discount rates are being mismatched. So my suggestion to you is, see if you can find some acquisition valuation. You'll find several in Harvard Business School case studies. Take a look at them and just check for consistency. Forget about everything else. Don't even debate, is the growth rate too high? Is the growth? Those are all ways which are legitimate ways in which value can be moved. This is not a legitimate way. Just to complete the story. Who ran First Boston's M&A department in 1979, do you know? It's two people, actually, co-heads of the department. Bruce Wasserstein and Joe Perella. There's something about this process that should trouble you. Bruce Wasserstein and Joe Perella ran this department. They did valuations like these, and how were they punished for doing it? They got to set off on their own and set up an M&A boutique providing even higher level advice to companies on what they should be paying. And the way I described it is they couldn't value a $20 bill in a brown paper bag, but they were very good brown paper bags. And just to show you that they got punished for doing that, what happened to Wasserstein Perella at the end? Dresdner Bank paid $2.5 billion to buy Wasserstein Perella. And I'm not kidding. You know what they said at the time of the acquisition? They said they were doing it to buy the valuation expertise of Wasserstein Perella. There's something here that means that if you do things right, you should be rewarded. You do things wrong, you should be punished. You don't see that consequence here. Okay? So check for mechanics, check for first principles, then start debating. Is 10 times earnings right? Is this growth rate a reasonable? And are you reinvesting enough? Those are all legitimate questions, but first make sure the first principles are not being violated. Any questions on this valuation? No? So let's get back to where we left off in the packet. Yeah? We've kind of set up the consistency principle. Now we're ready to at least set the table on what drives the value of a company. We're going to approach this, and this is going to take us through the next 7 sessions in 4 steps. We're going to start off today talking about discount rates, and that's going to take us probably 3 sessions to go through. Risk-free rates, risk premiums, cost of equity, cost of debt, weights. Right? So we're going to start with that. We're going to emphasize consistency all the way through. We're going to talk about how to estimate discount rates in different currencies, nominal versus real, when you'd use one over the other. Then I want to talk about earnings and cash flows. What is the company doing right now? What are those financials telling you? Because that's where we start as our raw data. Okay? Then I want to focus on future numbers. How do you come up with growth rates? What's the most consistent way of estimating growth? I can't tell you what's the right way of estimating growth, because for each company it might be different, but what are the consistent ways of estimating growth? And I want to tie up my loose ends by, at some point in time, putting my company into what I'm going to call stable growth. It's an artificial device, but the reason we have to do that is, at least in theory, publicly traded companies can last forever. We can't estimate cash flows forever. So at some point in time, we want to stop estimating cash flows, and in the discounted cash flow world, to make that stop, we have to assume that cash flows beyond some point in time will grow at a constant rate forever. It's one of the most diabolical assumptions in valuation because it can lead you into some strange places. But we have to deal with it right, because that's how we tie up the loose ends. We come up with that proverbial terminal value. And then I want to talk about picking the right model. We talked about being parsimonious, picking the right model for your company. I want to come back and talk about that. Before I do that, though, let me kind of establish what's going to drive. We're going to look at a bunch of different models, and after a while you're going to say there's 16 different discounted cash flow models. To show you what they have in common, I'm going to list out what I think are the 4 questions that you need to answer to value any company. Here's the first question. Tell me what cash flows you're generating from your existing assets. You made investments already on the ground. What are the cash flows you get from those existing assets? So I'm not even looking at the future. I'm saying you have investments already. Tell me what they're throwing off. Those cash flows can either be before debt payments, in which case they're cash flows to the firm, or after debt payments, in which case they're cash flows to equity. Second question I'm going to ask you is, how quickly will those cash flows grow in the future, right? Key input in valuation. Again, that growth rate can either be in equity earnings, net income, earnings per share, or in operating earnings, in which case it's going to be a different number than the equity earnings number. So cash flows from existing assets, growth rate. Then I'm going to ask you, how risky are those investments? Because I need to come up with a discount rate. Whether I come up with a cost of equity or cost of capital has already been set in stone, because the minute you picked the cash flow and you told me how you estimated growth rate, you told me what discount rate you need to use. So if you said, look, I'm projecting cash flows after debt payments, growth rate, and equity earnings, you kind of locked me into using cost of equity. Cash flows before debt payments, growth and operating income, you've locked me into firm valuation. And the final question I'm going to ask you is, when is your company going to be a stable growth company? And you can already see that that 4th question is going to be one of the toughest ones to answer, especially if you're working with a young company, an Under Armour, a Google, a company that's still a young company. Yes, Luis?
You said that operating needs are also debt payment?
We have to define. So when we get to the debt stage, we have to have a definition of debt that captures all our different kinds of debt. We'll have to come, maybe, should lease commitments be part of debt? What about underfunded pension obligations? So there are all those detail issues we have to come up with. But whatever choices we make there, so in the cash flow phase, we said we're going to treat lease as debt, we have to treat it as debt all the way through the process. Okay? Consistency is key. Now, if you look at those 4 questions, how you answer those questions will be what's different across the models. Let's start with the oldest discounted cash flow model in town, which is the dividend discount model. How do we define cash flows? We define them as dividends that will be paid to stockholders, right? The growth rate we should be talking about should be growth in equity earnings / dividends, because we're talking about equity cash flows. The discount rate we use should be what? Cost of equity or cost of capital? You're discounting dividends. It should be cost of equity, because dividends go to equity investors. And when we say, when will the company be a stable growth company, we're talking about when will dividends start growing at a constant rate forever. So the classic dividend discount model, everything is defined in terms of dividends. Cash flows are dividends, growth rate is growth rate, and equity earnings and dividends. Discount rate is a cost of equity, and in stable growth, you're talking about your dividends growing at a constant rate. For the moment, don't even worry about all these details, because we're going to come back and talk about them. I just want you to think about those 4 pieces. So that's with a dividend discount model. Let's move one step up the complexity ladder. One of the problems with the dividends is you're trusting what a company can pay out is what it should pay out. If companies hold back cash, we said there's a more generic definition of cash flow to equity, which is the cash flow that could have been paid out in dividends. That's a free cash flow to equity. So let's look at a free cash flow to equity model. We're going to define cash flows as potential dividends, what the company could have paid out, which might be higher than actual dividends. It might be lower in some cases, especially in a year like this one. The growth rate you're going to talk about is growth rate in that free cash flow to equity, right? Which is going to be a function of equity earnings, how much you reinvest. Your discount rate is still going to be the cost of equity, because we're still talking about equity cash flows. And when you talk about stable growth, you're talking about stable growth in free cash flow to equity. The model doesn't change. All you've done is replace dividends with free cash flow to equity. Right? Will it give you a higher value or a lower value than a dividend discount model? It depends. It depends on what? On whether dividends were higher than free cash flows to equity or lower than free cash flow to equity, so it can cut both ways. So dividend discount models, free cash flow to equity models, we're focusing on equity. Now let's move one further step up the ladder. We want to look at cash flows to the firm, which are pre-debt cash flows. If you're looking at pre-debt cash flows, we're going to start with operating income. Don't worry again about the details. If you've never dealt with cash flows, everything here is going to look like Greek. We'll come back and kind of fill in the details, but we're looking at pre-debt cash flows. For the moment, all I want you to focus on is the kind of big picture. So the cash flows are before debt payments, before interest payments, before principal payments, cash flows of firm. The growth rate should be growth in operating income, not net income, not earnings per share, because you're talking about firm valuation. The discount rate has to be the cost of funding the entire firm, which is the cost of capital. And when we talk about stable growth, we're talking about cash flows to the firm, pre-debt cash flows growing at a constant rate forever. What I'm trying to emphasize, whether you're talking about the dividend discount model, free cash flow to equity, or free cash flow to the firm, the pieces of the puzzle stay the same. How you estimate them might be different, and they can make a difference in your final answer. Okay? But once you've chosen that path at the start of the process, stay consistent with that all the way through. Now, obviously, if you look at those pages, there are lots of details: risk-free rate, risk premium, beta, cost of debt, debt ratios, EBIT, tax rate, capex, every single item here could give you a headache. That's why we're going to spend 7 sessions on it, is to kind of give you further headaches. So let's start with the first piece of the puzzle, discount rates. Okay? We're going to spend, as I said, a big chunk of the discounted cash flow part talking about the inputs, because once you've got the inputs nailed out, the actual modeling is relatively simple. This is not a modeling class. Dan teaches that class. So if you want a modeling class, build off models, it's a different class. This is a valuation class. So we're going to focus in on the consistency principle that should drive your inputs, and the model will actually fall out of your input. There is no modeling involved, because once you've got the inputs nailed down, everything else should emerge from them. So let's start with discount rates. Do discount rates matter in discounted cash flow valuation? It's kind of a stupid question, but humor me. Of course, right? It's discounted cash flow valuation. How much should they matter? In other words, the question I'm asking is, if you're doing a discounted cash flow valuation, what portion of your value do you think is driven by your discount rate inputs, and what portion do you think is driven by your cash flow growth inputs? When you're going to screw up, let me put it in a cruder way. When you're going to screw up an evaluation, is it because you usually get the discount rate wrong, or because you got the cash flows wrong? Actually, it's the reverse. In most valuations, if you look at big-time screw-ups, we're not talking about consistency issues, actually getting the numbers wrong. It's the cash flows, the margins, the turnover ratios, the numbers that you use for cash flows were wrong. The reason I say that is, if you look at how much time people spend on estimating discount rates, if any of you worked in valuation, you spend 80% of your time estimating discount rates, and towards the end somebody says, well, we have to come up with the cash flows. Okay, let's throw in a margin, let's project out the numbers, and it's almost an afterthought. The cash flows kind of come out in the last 2 hours of the analysis. So I want to keep this in perspective. Discount rates matter, but they're not the key piece in evaluation. That's why I see people say, I don't like betas, I want to use something else. I'll concede it to them. Go ahead, give me a different model, I can live with it. But let me estimate the cash flows, because that's the number that I'm worried about here. So let's start with discount rates, because they are a key input into valuation, but they're not, in my view, the number that really determines good valuations versus bad valuations. I want to still emphasize the consistency principle. One thing we talked about, equity cash flows, use cost of equity, firm cash flows, I'm going to add 2 more consistency principles to it. You pick a currency to do your valuation in, your discount rate has to be in the same currency as your cash flows. This might seem like a trivial thing, but it's one of the most common mistakes in valuation. We'll come back and talk about why. Your cash flows are in pesos, your discount rate has to be in pesos. Your cash flows are in reais, your discount rate has to be in reais. You can't just in Excel change your currency. Everything is in the same currency. It's not as trivial as that. You have to think about how your inputs will vary. It also is a function of whether you want to do things in nominal terms or real terms. You know the contrast, right? Nominal terms, what do? You build inflation into all your numbers, right? So when you put prices next year, 2 years out, you're building in nominal prices. When you do things in real terms, you strip inflation out. Most valuations, are they nominal or real valuation? I mean, let's take developed markets, US, Europe. I mean, when you see cash flows in discount rates, nobody ever says, are they nominal or real? But are they nominal or real? And how can you tell? In fact, if you ask the analyst, you say, huh? Because most analysts don't even think, because they use past growth rates often to project out future growth rates, and those past growth rates reflect inflation. The only problem is that inflation might be very different. That's a different issue that you're going to deal with. When you ask them, how do you come up with discount rate? They say, I started with a government bond rate and built up. And if you use the T-bond rate as your risk-free rate, you've already chosen the nominal route, right? But it's worth exploring. Are you doing things in nominal or real terms? Because sometimes you see inconsistency. People using real prices and using a nominal discount rate to match up. So here's the first piece of the discount rate puzzle. I want to talk about the cost of equity. Again, let me lay out the kind of intuitive place from which I'm going to be coming for the cost of equity. The cost of equity should be higher for riskier investments than safer ones. Right? So far, I haven't said anything controversial. That's pretty much, that should be kind of common sense. How we measure risk, however, can be different depending on whose point of view you bring into the valuation. Let me explain what I mean by that. When you look at a company has lots of risk. Different places. You take a company like Disney, risk from a new movie, risk from expanding California Adventure, risk from interest rates moving, risk. I mean, you can have 25 different risks driving your company. With publicly traded companies, at least in traditional valuation, we make the assumption, we have to come back and examine how well this assumption holds up. We make the assumption that the risk in a publicly traded company is measured from the perspective of the marginal investor in that company. What I'm trying to say is, if you're buying 100 shares of Disney and that's all the money you have, don't tell me you're going to take your perspective of risk, because you really don't matter. I know that's a brutal thing to say. What drives the price of Disney are those people bringing in hundreds of thousands of shares, buying the stock at the margin, determining the price. That's a marginal investor. The marginal investor, therefore, has to trade big blocks of stock and trade it. I mean, you can't just hold on. So Larry Ellison is not the marginal investor in Oracle because he might own a lot of stock, but he doesn't trade it. We make the assumption that that marginal investor is diversified. It's one of the most critical assumptions that drives the way we think about risk. Do you see why that matters? If the marginal investor is diversified and he looks at Disney, he sees all that risk, but he's going to take a big chunk of that risk and say, I don't care about the risk, it's going to average out. That's the core belief that drives how we think about risk and return models. We divide risk into two pieces, risk that can be diversified away and risk that cannot be. And we focus only on the risk that cannot be diversified away in coming up with a cost of equity. Notice I haven't even used any technical words, no beta, no volatility, nothing. I'm just talking in terms of general stories. Now you can already see that this assumption is going to get us into trouble somewhere, right? You're valuing a small emerging market company. You can already see that this assumption is going to be much more difficult to sustain than if you're valuing a large market cap, publicly traded company in the US or Europe. You're valuing a private company, you're off the chart completely, right? Because you only invest in the company, the owner is not likely to be diversified. For the moment, I want to kind of hold off on those issues, but we have to come back and re-examine those issues. Okay? So once you accept that premise, that only the risk that cannot be diversified away matters, then we get into the process of which model do you want to use. And I'm going to list out all four models that you can use in finance here. The first, the oldest model, still the default model in most valuations, the CAPM, where you measure all that non-diversifiable risk with a single beta, right? So I come to you with a company, you ask me, what's the beta of the stock? But remember, beta measures only the non-diversifiable risk. It, of course, follows the standard properties. It's scaled around 1. Okay? So if you're more exposed to market risk, your beta is greater than 1, less exposed, less than 1. Oldest model around, still the default model. Amazing, after 45 years, it kind of hangs in there. The arbitrage pricing model and multi-factor model take that 1 beta and split it up into many betas. So basically they say market risk can come from 4, 5, 6 places. We'll estimate a beta against each one. So what's the difference between the two models? Does anybody remember from corporate finance what the difference is? What's the difference between the arbitrage pricing model and the multi-factor model? They both have multiple betas, 4, 5, 6 betas. What's the key contrast between the models? In the arbitrage pricing model, what are the market risk factors? You said there are multiple risk factors. They're factor 1, factor 2, factor 3, factor 4. It's a statistical model. It doesn't put a name on the factors. In the multi-factor model, you call the first factor interest rates, the second factor inflation rates. Macroeconomic names get attached to the models. But they both take that single beta and split it into multiple betas. And the last set of models are what I call proxy models, where instead of trying to measure risk, you ask a different question. What kinds of stocks earn high returns? So if you're a small cap stock, historically you've earned higher returns than a large cap stock. you estimate your cost of equity based on the characteristics of the company, how large it is, what its price to book ratio is. So you've in a sense given up on risk. In all of these models, what you end up with as an expected return is your cost of equity. The question is, how do you get there? So let's take the CAPM and talk about inputs. You're saying, how come not the everything I say about the CAPM will apply to the arbitrage pricing model and multi-factor model in the following sense. When I talk about what will happen to the beta of a company in the CAPM, everything I say about what will happen to the beta of a company applies if you have 5 betas or 1 beta. So the reason I'm sticking with the CAPM is I don't want to talk about 5 betas and repeat myself. So I'm going to talk about the 3 basic inputs I'm going to use in the CAPM. We're going to start today with the risk-free rate. That seems like a no-brainer, right? We all know what the risk-free rate is, or do we? Especially after the last 4 months, it's worth examining what exactly is a risk-free rate. Because if your base is shaky, then the rest is going to fall apart. So let's get that number nailed down. It's supposed to be the one fact in valuation is the risk-free rate, but even that's not a fact anymore. Then I want to talk about equity risk premiums. Huge number driving valuations. In corporate finance, we talked about one way of estimating equity risk premiums. Here, I want to kind of delve into that. What's the equity? Because it's going to have a big role in what you end up finding out about your company at the end, undervalued, overvalued. And then after I've dealt with equity risk premiums, I want to come back and talk about betas. So let's start with risk-free rates. Let me give you the definition of a risk-free rate, then we'll add on the criteria you'd need for something to be risk-free. For an investment to be risk-free, you need to know what the returns are going to be on that investment with certainty. There can be no uncertainty. So basically, you need to be able to tell me, I'm going to make 3% guarantee. So you can already see 2 conditions that come out of that definition. First is your investment cannot have default risk and be called risk-free. Even an iota of default risk, a tiny bit, won't work. Second, there can be no reinvestment risk. You see what I mean by reinvestment risk? You have a cash flow in 5 years, a 6-month T-bill is not risk-free, even though you know exactly what you make in 6 months because you got to reinvest. No default risk, no reinvestment risk. So here are the two principles that I would pull out of those criteria. First is your time horizon matters. When you ask me what's the risk-free rate, before I answer, I'm going to ask you what are we talking about? 2-year cash flows, 5-year cash flows, 10-year cash flows? I can't give you an answer. This is a great trick question in an interview, right? What's the risk-free rate? If the person jumps in and gives you an answer, you're fired. No, you're not hired him, yet you can't fire him. But when somebody asks you what the risk-free rate is, you need to figure out what the time horizon is. I wouldn't even ask you what currency, because it depends on what currency you're talking about. Second, you said that if there's even an iota of default risk, it's not risk-free, right? You can already see that in many emerging markets, and maybe in some developed markets, you can't take the government bond rate and use it as a risk-free rate because there is now a shadow of default risk kind of hanging over that rate, which pushes up the rate. There's a default spread in there. So I'm going to take you through 5 tests. Let's see if we can get the risk-free rate. I'm going to start with easy to tough. Right? Let's work through them. Let's start with US dollars. How many of you are doing US companies? I'm assuming some of you have picked your companies. This is not good. Now, either the rest of you haven't even thought about companies. There is a project. You have to pick a company. Do it sooner rather than later. Right? About 80% of you will end up with the US company simply because of convenience. You think about a foreign company. I don't want to deal with that. I'm graduating in May, and let me do a US company. So you'll end up with US companies. So let's get the risk-free rate nailed down, right? First part of the valuation. I'm going to give you 4 choices here for the risk-free rate. This is for your entire valuation. A 3-month T-bill rate, a 10-year T-bond rate, a 30-year T-bond rate, or an inflation index rate. And if you want to add a 5th choice, you can. And you can see the numbers are going to be very different. There's a 3-month T-bill. This is the start of this year, early January 2009. 30-year T-bond and the TIPS rate. First, valuation, short-term exercise, long-term exercise. It's long-term. You're saying, what if I have my terminal value in 1 year? It doesn't matter because the terminal value captures cash flows for ever, right? So short-term rate should be off the table right off the bat. 10-year rate or 30-year rate? At least in theory, what seems more appropriate? The 30-year rate actually sounds more appropriate because your cash flows last forever. And if you're matching up, you're saying 30 matches better than 10. But here's a pragmatic consideration. All your other inputs have to be based on your risk-free rate, default spreads, risk premiums. Default spreads, for instance, are computed by looking at what corporate bond rates are relative to the risk-free rate. How many 30-year corporate bonds do you see out there? Getting a default spread with 30-year bonds, getting an equity risk premium with 30-year bonds is more difficult than with 10-year bonds. I know that I'm kind of cutting corners here, but I'm going to go with the 10-year bond rate simply because my other inputs get a little easier. How come not the TIPS rate? What's the TIPS rate? That's like it's a real risk-free rate. If I were doing analyses in real terms, that is the risk-free rate I'd be using. But since I've chosen the nominal route, I'm going to go with a nominal rate. If you want to do things in real terms, there's no harm in using a real risk-free rate. In this case, that would be the TIPS rate. So first, you want a long-term rate. In the US, I'm implicitly assuming that the Treasury has no default risk. Not because it's an incredibly well-managed institution. It's not. But because they control the printing presses, right? Just run it a little faster. So that's it. That was the easiest test. Now is a slightly messier test. Some of you will pick European companies which are part of the EU. We won't even go. Britain and Switzerland we'll come back to. Okay? You have a French company, you have a Greek company, you have a German company. You will need a risk-free rate in euros, right? So you're going to go to the FT. Actually try the FT. FT is a great source for, for euro rates. You're going to go to the government bond page. You're going to look for a 10-year government bond in euros. And you're going to run into a little problem. And this graph kind of captures the problem. Do you see what the problem is? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11 different countries issue 10-year euro bonds, and the rates are all different. They're all in euros. They're all 10-year bonds. The rates are different. So let's make this a really difficult exercise. You're valuing a Portuguese company in euros, and you want a euro risk-free rate. What should you use as your risk-free rate? Can I use a Portuguese rate? No, not the 10-year euro bond rate. Step back. Why? These are all euro bonds, right? They're all government bonds. So why are the rates different? I mean, it's not like 1998. We had Drachma bonds and Deutschmark bonds and French franc. These are all euro bonds. They're all 10-year bonds. So there's only one reason the rates can be different, right? There has to be default risk. When I did this in Greece a few years ago, they said, no, there's no default risk in Greece. I said, hey, I'm not coming up with this number. Take it up with the market. The market thinks there's default risk. It's built into the rate. So there's the answer, right? So what should I use as my risk-free rate for a Portuguese company? I'm going to use the German rate. Why? Not because Germany is going to invade Portugal. And this is a touchy issue, so, right? But because it's the lowest of the risk-free rates. Yep. You could actually say even the German bond probably has some default risk with German. In which case you might have to find what is a default-free entity in euros? Some central bank in Brussels or something? I don't know. There's probably, but the reality is a German bond is going to get you closer to a risk-free rate than any other bond. And you could say even that's probably not quite risk-free. I'm going to take a little off it. But then you make a judgment on what that little is. But you want to get as close to the risk-free rate as possible, which means in any country that you're in, you're going to end up with the German 10-year euro bond rate. But don't get too caught up in the German. See why? 5 years from now, Portuguese bond might have the lowest rate. Miracles can happen, in which case you got your risk-free rate right there, right? So don't get caught up in the German part of it. It's the lowest of the euro bond rates being used as a risk-free rate. Any questions on that? What if you're doing a British company? Then you're back on US dollar territory, right? Go look at the gilt rate, 10-year pound rate, if you're doing a Swiss franc, Norwegian, Swedish. The countries that have their own currencies, you could take with it, but implicitly you're then saying that these countries have no default risk, and I'm going to use that rate. And you might be able to get away with it with Sweden, Switzerland, the UK, and the US. Oh, yeah, each person has their own subjective judgments. If you feel UK has default risk, then you're closer to this problem. I told you we're going to go layer by layer. So US dollar was a no-brainer, right? You open up the journal, you were done. Euros was a little more of a brainer, if that's the right word to use. A little brainer, basically, because you had to pick the lowest rate. Now you need a bigger chunk of your brain working with you when you come up with a risk-free rate. You need a risk-free rate for India. You're doing an Indian company. Yep.
I have a more fundamental question.
Right.
If I'm not a US investor, but I am an Indian person.
First, remember, don't let the identity of the investor drive your currency choice. Any investor can think in any currency terms, even though they don't use it. It's like saying a Brazilian investor can't think in dollar terms. Guess what? Brazilian investors can think in dollar terms, even if they do everything in real. So currency is an artificial choice. It's actually a problem, a trap that appraisers fall into. Last week, in fact, I was in a conference call with an appraiser who was dealing with a lot of clients who were in other countries, and he said, well, because my investor is Polish, I need to use, is Poland in the euro now? No, I need to use a Polish risk-free rate. I said, why? He said, I can't use a euro risk-free rate because he's Polish. Says who? Investors can switch. I mean, in a sense, currency matters only because it drives inflation. So once you've decided that this is the currency you pick, don't let the identity of the investor drive your currency choice. Make it pragmatic. We'll talk about how you make a choice of currency, but the investor is going to be the last piece of the puzzle. I really don't care who the investor is. It's what makes it easiest for me to value the company. Because once I've done a valuation in dollars, can I convert it to rupees? Sure, right? Make it at the last step if you feel that's an easier way to do it. Okay? But let's suppose you are valuing an Indian company, and a few of you might pick Indian companies. You want a rupee risk-free rate, right? So you look up the Indian 10-year government bond, 10-year rupee bond, and the 10-year rupee bond rate on January 1st, 2009 was, let's say, 10.5%. It's actually dropped since, but it's 10.5%. But here's the problem. Unlike the US, the UK, and Sweden, where I said, hey, I'm not worried about default risk, I'm much more worried about default risk here. And it's not just a subjective feel. I went to Moody's.com and checked the sovereign ratings. Have you seen how sovereign ratings are presented? If you get a chance, visit the Moody's site. They have sovereign ratings for countries. And for every country, they will list actually two ratings. A foreign currency rating and a local currency rating. What's the difference? So you see Indian foreign currency rating, local currency rating. Why is there a difference? Well, if India borrows in dollars, there's more default risk than it borrows in. So they give you two ratings. I looked at the local currency rating, and what I did not see was what troubled me. I didn't see a AAA rating. I know I'm trusting ratings agencies too much on this one. But in the UK, US, Sweden, and Norway, they're still giving me AAA ratings for local currencies. But for India, the local currency rating was BA3, which is not a bad rating, but it's certainly not AAA, which effectively means that Moody's at least thinks there's some default risk in the Indian government bond in rupees. You think, how can there be default risk in the local currency? Because there have been countries that have defaulted in the local currency. Latin America used to be littered with country bonds that basically what would happen is you'd have a revolution. A new leader would come in and say, that old guy's bonds, I'm not taking care of it. I mean, what, Brazil went through, 6 different reals? They just replaced the whole currency with that's not a good practice, right? You take an S out at the end, so now it's a new currency, add 2 S's at the end, new currency again. No. But it reflects, I think, part of the problem here is we assume local currency bonds never get defaulted on by governments, but they sometimes do. The odds are low, but you're basically building it into the risk-free rate. So here's my question for you. If you buy into the rating, and that's a big if, and I told you that the typical default spread, that should be BA3, not a BAA3, was 2.5%. I want you to tell me if you can bring those two pieces of information together and tell me what risk-free rate you would use for India. And let me go through the choices. You're going to stick with the 10.5% because that's a government bond rate. You're going to add the 2.5% to the 10.5% to end up with a 13% rate. You're going to subtract the 2.5% to come up with 8%. Or you're going to come up with your uniquely creative way of doing something with the 2.5%. Is everybody clear on the question? So you got the government bond rate. I'm saying you need a risk-free rate in rupees. Don't even look further down the road. You need a risk-free rate in rupees. I want you to pick a number there. Which do you think is the right number? First, should I subtract out or add the 2.5%? Subtract out. Do you see why? Because the 10.5% is embedded in the default risk, and I want to take out the default risk. This actually goes against conventional practice. Conventional practice, they'll use the 10.5% as a risk-free rate and say, why are you making a big deal about it? The reason I'm making a big deal is you end up double counting risk. You know how? These people start with 10.5% as a risk-free rate. Then they'll get to the risk premium. Guess what they use as the risk premium? A much higher risk premium. Why? Because India is a risky country. In fact, they'll often take that same 2.5% added to the risk premium and come up with a higher risk premium. In which case, you've hit the company twice on the head for having default risk. Once through the risk-free rate, and one through the screen. I'm not saying there is no country risk in India. I'm saying the risk-free rate is not the place to throw in country risk, because it's, I mean, how can you call something risk-free and have a 2%, 3%, 4% spread built into that rate? Which means if you're working with emerging market currencies, getting a risk-free rate itself is going to be a bit of a chore, right? You can't just take the government bond rate in Brazil or Argentina or Venezuela and subtract out the default, or just and use that rate. You have to subtract out the default spread based on the local currency rate. Any questions on? Yes. We'll come back and talk about it, because what I actually have is a table. Actually, I'll talk about it now. Since I have to work with country ratings so much, I have a table that I have on my website which lists for each rating what the typical default spread is. And there are two places I go to get that number. One is I look for countries which are bonds issued in another currency, US dollars, euros. You see what the advantage of that is? If I can see what a BA3 rated country issues dollar-denominated bonds at, and I compare it to the T-bond rate, the difference will do it. The other place I go is actually a fairly recent place. Do you know what I'm talking about? Where else can I get default spreads? And the CDS market, credit default spread. This is a market that got Lehman into trouble because they used it as a funding device. But it's actually, if you think about it, what the CDS market allows you to do is just bet on default risk in individual companies and countries. So you can say, well, I think the default risk in Russia is 300 basis points, and you trade on it. So you actually get a market price for a country, and they also list out the ratings for each country. So the two things I use are bonds issued in euros or dollars that I can compare to a risk-free rate, and the CDS market to kind of come up with a consolidated table. The reason for that is if I'm in Africa or much of Asia, there might be no easy way to get a default spread by looking up a dollar-denominated bond, but if I know the rating, I'm pretty much home free. Okay? Yes?
So the serious thing would be a problem for the US treasury because it's
Not in the dollar market. The spreads you see are in the euro market. That's actually not. See, if you go to Bloomberg, you'll see default spreads. It actually lists all of them by default, but you can actually pick just dollar default spreads, euro default spreads. In the euro market, there's a default spread attached to the US Treasury. But in the dollar market, there is no default spread attached. So but I'd keep my eye on that, because if that spread starts to widen out, the market is saying, we think there's default risk in the US Treasury, you've got to build it in. Okay? Fourth test. Let's suppose you now are sick and tired of these currencies. You decide to do everything in real terms. Remember, in real terms, there's no currency, right? Currency is out of the picture. Everything is being done in real terms. You need a real risk-free rate. So you'd like to get a default-free rate of, you'd like to get a rate of return on a default-free instrument, which is in real terms. I gave you one choice, right? The TIPS rate, 1.5%. But let's face it, you're almost never going to do analyses in real terms in the US or Europe, because it's far easier to work with nominal numbers because your taxes are based on nominal numbers. You fall back on real numbers only when you get desperate. So let's say you're desperate. You're desperate not in the US, you're desperate in Brazil, maybe in Indonesia, maybe in Zimbabwe. What's the inflation rate in Zimbabwe now? Like 180,000%. Forget about local currency. You might as well give up on it. You want a real risk-free rate in Zimbabwe. So you look for a Zimbabwean TIPS bond, right? There's no such thing. I'll save you the trouble. So here's the question for you. I gave you the yield on the US TIPS bond. Do you think I can use that as my real risk-free rate in Zimbabwe? Under what conditions? Basically, it'd be nice, because this would be great if it were true, right? Because I can take the TIPS rate, travel around the world, no problem, risk-free rate, risk-free rate. But what is the implicit assumption I need to make for this real risk-free rate to kind of travel around the world? What's a real risk-free rate? It's what you're making in real terms after, with no risk in an investment, right? If capital flows freely across markets, that's a big if. You see what's going to happen if real risk-free rates are different in different countries, right? If I tell you the real risk-free rate in France is 4%, the real risk-free rate in the US is 1.5%, and the really real risk-free rates, what should happen? Capital should flow out of the US into France. So in a world in which capital flows freely across markets, you're right, you can take the 1.5% as your risk-free rate globally. But you think capital flows freely into Zimbabwe? It might flow freely in, but it's not flowing out, which kind of puts a crimp on capital flowing in. Yeah.
This assumption, isn't it already on the assumption when we pick the credit spread using the Brazil issued US dollars bond?
Not necessarily, right? Because
Brazil.
Because then I'd still subtract out the spread from the 10-year nominal REI denominated bond rate. So if there is in fact a real rate of return built into that rate that's higher than the rate built into the T-bond, I leave it embedded. The spread, you're right, I'm comparing dollars to dollars, but then I take the spread and apply it on a local currency bond. The 10.5% for Indian rupees might in fact reflect a real risk-free rate that is different from the real risk-free rate in the US. But you're right, implicitly when we do valuation, we hope and we pray that real risk-free rates are not different across currencies, because that's going to cause some real problems down the road in how the value of the company will emerge with different currencies. Right? But with real risk-free rates, we make that explicit assumption, 1.5%. If we're not willing to make that assumption, then we have to come up with a different way of estimating real risk-free rates. What's a different way? Any other ways you could estimate real risk-free rate? What's a real risk-free rate? It's what you're going to deliver in commodities and services. Lewis?
Could we use gold?
Gold is kind of this, yeah.
The last 100 years in gold? Because that's
Gold is the strangest of all investments, all right? In a sense, I'll give you the exact reason why gold is such a dangerous investment. If you think about adding gold to your portfolio, it's historically been insurance, right? That's why I add gold. You could visualize a scenario where the expected return on gold is negative, right? It has nothing to do with the real risk-free rate. It actually is, if I am worried about everything else going on in the world, I'm going to buy gold even though my return is negative. So it's really not a real return on the entire economy. It's a real return on gold.
But, yes, but isn't the risk-free rate in Japan, I don't know if
Right.
it's now, but it was negative for quite a...
The real risk-free rate, only if you're willing to buy into the inflation assumptions that people make, right? Real risk-free rates, you take the nominal rate and subtract out what analysts say.
So it stayed negative
Real risk-free rates can become negative, but globally, here's the catch. If your global economy in real terms is growing, your real risk-free rate should reflect that growth, because real risk-free rates are basically delivering more in goods and services to people. So which in fact is actually an approximation you can use for the real risk-free rate. If you're in an economy and you don't buy into the TIPS rate being your real risk-free rate, rather than look at the price of gold, look at the real growth rate of that economy, the expected real growth rate, which can be a negative number in some countries. But if it's 4% in Zimbabwe, which I think is completely unreal, but let's say it's 4%, then you'd use that as your real risk-free rate. I don't like this because it is completely subjective. You think about a real growth rate for India, and I think about a real growth rate. We could come up with different numbers, but here's why I can live with it. If that is the real risk-free rate you're using, and it's also the growth rate you're using when you value the company, it's kind of self-correcting, right? If you overestimate one, you overestimate the other. You underestimate one, you underestimate the other. So if you truly get desperate, you can't get a currency risk-free rate, you can't go to a different currency, you can, in fact, try to build it off the real growth rate. Yes?
Just one question, I don't know whether it makes sense. or
No.
not. The duration on a TIPS bond will be very small, typically. Will that have an impact?
No, duration on a TIPS bond is very high, right? Because duration is a weighted average of when your cash flows come due. So it actually, because your cash flows are still, in fact, the duration on a TIPS bond and on a nominal bond will converge if expected inflation comes in exactly as predicted, right? They will diverge to the degree that inflation is higher or lower than expected, so it can cut both ways. So it's kind of uncertain which direction the duration is going to cut. So now, that I think can't be a reason against a TIPS bond. Yes?
Is there any political risk associated with assuming that you can take the real growth rate as imported from?
Oh, absolutely. But that's why I'm saying if you're building it into both sides, it's going to cancel out. Do you see what I mean by building into both sides? Let's say you're overestimating real growth. Your discount rate is going to be higher, your cash flows are going to be higher. Okay? There's an offsetting effect. The advantage of linking risk-free rates to growth rates is if they feed into your valuation, both the numerator and the denominator, it's not going to push you off into a stratosphere. So that's almost a given, right? If you're working in Zimbabwe, let's face it, nobody knows when Mugabe is going to leave. In fact, we know when he's going to leave. When he's in a coffin and they carry him out, he's leaving. But when will that be? It could be 98, could be 99 before he dies. So there's a lot of uncertainty there, and we want to make sure that whatever we estimate with that uncertainty somehow doesn't affect only one side of the equation. We want to show it in both places. Okay. Any other questions? Yes.
If you, for example, want to analyze a company in China, then you will have to get the risk rate for China. Which one would you use?
Now wait. Let's in fact, let me put this page up, and then I'm going to come back to you, because I think you're already saying if I'm analyzing a company in China, I have to do it in the local currency, right?
Yeah, the local currency.
That's a choice. Do you have to? No. So let's first look at the choice, and then we'll come back and address that. Now, what should I use as a risk-free rate? Okay? Because it might be that there are some countries where you look at the local currency route and you say, hey, I'm not going down that route. Try valuing a Russian company in rubles. You will drive yourself crazy in the process of coming up with discount rates. It used to be true in Brazil until about 5-6 years ago. Nobody valued any company in Brazil in reais. They all valued in dollars. It's only in the last couple of years that I've seen nominal real-based valuations because rates are more stable. People are feeling more comfortable using it. 10-year bonds, and in fact, the ultimate admission that the government itself didn't buy into in its own currencies until a couple of years ago. The Brazilian government, when it borrowed long-term, always borrowed in dollars. It never borrowed in reais. So let's suppose you're in an emerging market, China, Indonesia, India, and you're trying to decide. There are three things you can do, right? One is you can decide to do everything in the local currency terms. So now let's look at the question. So you've decided to go down the local currency route. What's the question you'd have for China?
Then you're doing evaluation in terms of risk-free. I think in terms of real, not nominal, but real.
No, if you pick a currency, it's not real. If you pick a currency, it's automatically a nominal valuation, right? Currencies matter only because they add to the inflation component.
Let's go back based to the assumption that you said that the real risk-free rate is the same all around the world.
No, but even if you decide real risk-free rates are different, whatever you use, if you choose a currency, and you're doing a valuation in a currency, then you're building an inflation into everything, right? So it can't be. So if you're talking about a currency-based valuation, then it's not a real valuation. If you're doing things in real terms, you need to come up with a real risk-free rate. And that might be different in different parts of the world, but that's nothing to do anymore with what the Chinese currency is. It's either Chinese real growth that's going to drive it, or the TIPS rate. Okay. Yeah.
And that's my point. Exactly about this rate that you're going to use
Right.
for the
Real.
growth of China.
Okay.
The real growth of China.
It's going to be a high number.
Exactly. Because
So your discount rate is going to be.
the rate of China is much higher than the US.
Okay, fine. So let's say you use 7%. Let's go. What's the next step? So we have a higher discount rate. Why does that worry you?
No. I was just thinking.
Okay, so because in a sense, usually when people think about.
0.5% for the real growth rate.
But remember, if you use that in both your discount rate and your growth rate, and this is my point, it's almost canceling. That's why it's more important to me that you're consistent about using the same real growth rate in both places than that you get it right. I can live with consistency. I cannot live with problems that show up only in your discount rate or only in your cash flows. So your point is well taken, which is a real risk-free rate in China you might decide is 5%, but then the real growth rate you use when you value companies should also be the same number. So your first choice is you can stick with the local currency. And I'll give you, my personal view is I like to value companies in the local currency. You give me an Indian company, it seems to be a little artificial to value it in US dollars or euros or some other currency. So I'd like to value things in local currency. The only thing is you need a risk-free rate, and you have to get the risk-free rate the way we talked about. Start with the bond and subtract out the default spread. Or you can kind of build up to a risk-free rate, growth rate plus expected inflation, but you need a risk-free rate in the local currency. In some countries, you're going to give up. And to give you the example of Russia, Brazil 5 years ago, if you give up, you have two choices. You can do the analysis in real terms, in which case you need a real risk-free rate, and we talked about that. Or you can cop out completely and switch currencies. That's why I said in Brazil, people used to value Brazilian companies in US dollars. It seems like an easy way out, right? Because getting a discount rate in dollars might be easier than getting a discount rate in reais, but what's the price you're going to be paying? So you got your discount rate more easily, right? Now you get to the cash flows. What do we say? If your discount rate is in dollars, your cash flows have to be in dollars as well. But you're working with a Brazilian company, all the cash flows are in nominal reais, right? How do you go from nominal reais to nominal dollars? What do you need? You need forward exchange rate. The only problem is working with an emerging market, you might get 1 year, maybe 2 years, and then it dries up. And you have 8 more years to go. So here's my question to you. If you decide to do things in dollar terms, because you've given up on the first two, your discount rate is now in dollars, your cash flows are all in reals, let's say you have a 1-year forward rate, but that's pretty much it. How do you come up with expected exchange rates in year 2, year 3, year 4, year 5, year 6, year 7, year 8, year 9, and year 10? What do you have to do?
Inflation differences.
Purchasing power parity, right? Remember purchasing power parity? It's that theorem that we all said, no, it doesn't hold, let's skip it. Purchasing power parity basically means the same basket of goods has to cost the same around the world, which effectively means that if there are inflation differences, they eventually have to show up in discount rates. I know purchasing power parity is a long-term theorem. It's not about next year. But in valuation, purchasing power parity is critical. And here's why. If you're building in difference of inflation rates into your discount rate, you have to bring in those same differences of inflation into your expected cash flows. If you think inflation in Brazil is going to be 10%, the reais, and inflation in the US is 2%, roughly speaking, you should expect the real to devalue about 8% every year. I know part of you is saying, but my macroeconomists tell me the real is undervalued and it's going to... This is a valuation of a company. This is not about what your macroeconomist thinks about the currency. If you really think the real is undervalued, there's a much easier way for you to make money than to buy a company, right? What should you do? Go speculate in the currency market. Don't mess with a valuation. Don't bring in macro views you might have about the world. It's very difficult to do. To keep them out, don't bring them into your exchange rates, because then you'll end up with a joint effect, right? What you think about the company, what you think about exchange rates will both kind of come together. And I'll have a tough time looking at that valuation trying to decide, does this company look cheap because you like the company? Or does this company look cheap because you have a point of view on exchange rates that is different from what your inflation views are? So we'll come back to this, because clearly we will have to deal with this with some of our valuations. But keep that in mind. If you pick a different currency, it's not an easy choice, because your cash flows then also have to be in that currency. Final test with risk-free rates. Let's suppose you are valuing Embraer, Brazilian aerospace company. In fact, a lot of the numbers I'm going to show you are from a 2004 valuation of Embraer, at which point in time I'd chosen to value it in US dollars, because I gave up on real risk-free rates then. Not for want of trying. I actually tried for a week, and then I said, you know what, I have no idea what the risk-free rate is. So I decided to do it in US dollars. So you're valuing Embraer in US dollars, you're trying to come up with a risk-free rate to use in the analysis. You already, by this point in time, should be able to give me this answer, because we've talked about this issue a lot. So you want a US dollar valuation, you want a risk-free rate. Which of these rates would you use as a risk-free rate? As I go through each one, if it's not the rate, tell me why not. The interest rate on a real-denominated long-term bond issued by the government. What's the problem with that? Well, you're doing your valuation in dollars, you no longer care about a real rate. What about the interest rate on a US dollar-denominated long-term bond issued by the Brazilian government? It's 10.3%. Part of the reason it's so high is there's default risk embedded in there. If you build that into your risk-free rate, you are setting yourself up for a very dangerous problem down the road. You know, when I told you most Brazilian companies get valued in dollars, take a look at some of the risk-free rates they use. Almost every Brazilian company valuation I've seen in dollars uses the Brazilian dollar-denominated bond as the base of the risk-free rate, which means you've already built into your risk-free rate a 3%, 4%, 5% risk premium. And if on top of that you tell me you're going to use a higher equity risk premium, you've double counted that risk. Okay? So, not that. Brady bond, same problem, right? Still has default risk, not that. How about a bond issued by Embraer? It actually had a lower rate than the Brazilian government then, which tells you a little bit about default risk at that point in time, right? Obviously not risk-free, because Embraer has default risk, which basically means your life becomes very simple. You decide to do a US dollar valuation. I don't care where you're doing it. Russia, Brazil, Indonesia, your risk-free rate should be the T-bond rate. You do a yen valuation, the risk-free rate should be the Japanese 10-year yen rate. Don't make your life complicated. Pick a currency, look up the risk-free rate, let the risk premium deal with all the concerns you might have about that country. To show you how tough this can be, what I'm saying is if you have to value a Zimbabwean company in US dollars, use the T-bond rate as your risk-free rate, which means you're using a 2.2% risk-free rate. Part of you is going to be screaming out, but this is a Zimbabwe, I want to punish this company. This is not the place to do it. The risk-free rate is not the place to punish companies because you're worried about country risk. Final test on risk-free rates. I actually looked up a bunch of currencies. So these are actually the final currency risk-free rates that I looked up in Japanese yen, Swiss franc, Canadian dollars, Swedish krona, US dollars, Norwegian, British pound, Australian dollar, New Zealand dollars. Obviously, the risk-free rate varies across currencies. So when you use a yen cash flow, you have a lower risk-free rate than if you have a dollar cash flow. We've kind of talked about this as well. What's the main reason risk-free rates vary across currencies? Inflation differences. The real rate might be a factor, but when you see big differences in nominal risk-free rates, let's face it, inflation is the culprit. Which can, let me ask you then a follow-up question. You're valuing a company and you're trying to pick which currency to use. Using Japanese yen seems like a bonus, right? Because you use Japanese yen, you're going to end up with a lower cost of capital, lower discount rate. But what's the catch? If you decide to use Japanese yen for your discount rate, where else is it going to show up? When you come up with growth rates and cash flows, I'm going to ask you, is this the Japanese inflation rate which you built, which is close to zero? Or are you building in inflation rates from the US or the UK or Europe? Then you're going to end up with strange valuations, but there's no free lunch here. Pick the currencies with lower inflation. It's going to push down your discount rate, but it's also going to push down your growth rates and your cash flows. Okay. Any questions at all about risk-free rates? So start thinking about it. First you have to pick a company, but once you pick a company, start thinking about what risk-free rate to use, because it's not as simple as it sounds. And even in developed markets, we're starting to raise this issue. Can we use the government bond rate as a risk-free rate? We might have to do what we did for India for every government. I mean, the day might come where none of these governments are trusted as default-free, which means that adds a layer of complexity to our analysis. I don't think it's here yet, but I'm not shutting the door entirely. It might be here in 2 years, in 5 years, so I'm going to keep my eyes open on the CDS market, on potential defaults. I mean, Iceland. Yeah. So, I mean, it can happen. Governments can default. Sovereign debt can be paid off. Yeah.
In terms of the inflation differentials, how do you get the inflation? Can you get it on Bloomberg? Or because something like Brazil today, it's 5%.
I can getting inflation for last year is fairly simple, right? But there are two problems with it. That's last year's number. And two, it's a government number. You know what I mean by this? A lot of markets where governments actually play with the inflation number because it's so politically sensitive that they say, you know what, inflation is only 3%. You know what gives you away though? You look at CD rates at banks, they're at 15%. I guarantee you inflation is closer to 15% than to 3%. So listen to what the government tells you, but recognize first it's a number from last year, and B, that it's a number that can be cooked. Okay? So when you sit down to make estimates of expected inflation, look at things like what are people offering as interest rates? Because the reality is if we have high inflation, you've got to offer higher rates to encourage people to save. There's no easy way to get it because we ultimately care about expected inflation. Remember again, Bloomberg gives you historical data. Don't trust any of the forward-looking numbers in Bloomberg because they know barely more than you do about any of these numbers. So when they claim expected inflation, they've used some strange equation to get there. Take the historical numbers, make your best judgment, but try to build it into both sides of the equation. And that's why, for instance, if you underestimate inflation in India, what's going to happen? You're going to end up with a lower risk-free rate, but your exchange rates are also going to vary because of that. So make sure that whatever you do cuts on both sides of the equation, not just in one. Any other questions? Yeah. Oh, one more test. I must have been going crazy here. This is actually, the reason I put this test in is I've got this question about 50 times just in the last 3 weeks. And here's the question. And these are from people who are actually doing valuations. I'm valuing a US company, and the T-bond rate right now is 2.2%. It's too low. It's low, right? 2.2%. We haven't seen rates like this. Can I just change it to something which I think is more normal? Okay, so that's really the question I want to pose to you, because let's see if you can address this email. So can I replace the 10-year bond with something with like 4%, 4.5%, which is more reasonable? You can use you could use the current T-bond rate as your risk-free rate, and then you might have to, because if you just kept the risk-free rate at 2.2%, everything, holding everything else constant, that seems to indicate that what's going to happen to your cost of equity, cost of debt, etc. They should all fall, right? But that's happening only because you're not being internally consistent. Let me explain what I mean by that. Why is the risk-free rate 2.2%? Is it because people are incredibly optimistic about the future right now? One is growth prospects, the other is risk aversion, right? I mean, right now, people are so worried about risk that they will take their money and leave it essentially at a zero rate because they're so worried about risk. And how does that manifest itself in your risk premiums and your default spreads? We're going to talk about equity risk premiums, and I'm going to show you a graph of what, day by day, the equity risk premiums from September 12th to January 1st. September 12th, equity risk premium started at 4.53%. That's 2008. January 1st of 2009, barely 3 months later, not even 3 months, actually 3 months plus. Guess what the equity risk premium January 1st, 2009 was? 7%. Default spread, September 12th of 2008, BAA rated bond, 1.5%, January 1st it's 3%. You see where I'm going? If you decide to use today's risk-free rate, but you update the risk premiums to be today's risk premiums, you're going to be okay. It also then gives you an answer, when am I not going to be okay? If you're using 2.2% as your risk-free rate, using historical risk premiums that you were using, let's say, 6 months ago, spreads that you were using 6 months ago, you're going to overvalue your company because you're using too low a discount rate. So this is something we're going to come back to because all our valuations are going to be set, or many of our valuations are going to be set in January 1st, 2009. We have to deal with this frontally. How do we deal with the fact that the risk-free rate right now is too low? The reason I'm concerned about you replacing that rate with an average rate or a normalized rate is it's not a real choice. Today you can either invest in stocks or you can invest in T-bonds, right? If you invest in T-bonds, you can't say, I want 4% because that's what my historical average tells me I should get. Tough. You're going to get 2.2% whether you like it or not. If we think of investing as a game of opportunity choices right now, your opportunity choices, you can either invest your money in this company or you can put it into T-bonds and make 2.2%. Okay? We'll talk about ways in which you might be able to adjust the risk-free rate, but be very careful when you open the door because the minute you start touching the risk-free rate and replacing it with what you think is a more reasonable number, you have to start touching every other number in your valuation and replacing them with more reasonable numbers as well. And that could be a never-ending process in evaluation. Okay, so again, I don't want to set this as a final answer, but we have to come back because as you do your evaluation, you're going to run into this issue. We'll come back and talk about this in more explicit detail. So that's a risk-free rate. It took us a while to get through, but I want to make sure that's nailed down. Let's talk about risk premiums. Corporate finance, we talked about historical risk premiums. Most people who do valuation use historical risk premiums. What do they do for that? They look at over a long period, what did I make investing in stocks, what did I make investing in T-bonds and T-bills, and they take the difference. And they carry this over into other markets. What do you make equity versus a government bond? I, on my website, update these numbers every year. So in corporate finance, you saw what the, does anybody remember what the number was? It was 4.79%. Corporate finance, that was what, less than a year ago, right? What the heck happened here? 3.88%? Well, we had a really bad year. What do you think that does to historical premiums? Because you know, basically historical premiums, you look at what stocks have done over the last 88 years, and just the last year you wiped out 10 years of work. There you go. So the risk premium, the historical risk premium today, which actually is a little counterintuitive because if I ask you in intuitive terms, do you think risk premiums have gone up or gone down in the last year? You'd say, of course they've gone up. With historical risk premiums, they're going to go in the other direction. So these are historical risk premiums, and you already know some of the issues with historical risk premiums. Or if you don't, let's go through them. One is, what number you come up with will actually depend on whether you're looking at T-bills or T-bonds as risk-free, whether you're looking at arithmetic or geometric averages, and you can already see how different the numbers are. So the first problem you're going to run into is when you talk about historical premiums and I talk about historical premiums, you can come up with two different numbers. Second problem, what are these numbers in brackets below? How do I get these risk premiums? What am I doing? I'm taking 80 years of data, I'm adding them up and dividing by 80, or coming up with an average over the periods. Stat 101, right? You have 80 data items and you come up with an average. That average is going to come with a standard error. That number below the numbers you see there is a standard error. And that should scare you. You know why? When I tell you the risk premium over the last 10 years is minus 6.26%, the number, the negative sign alone should scare you. Okay? But then you say, you know what? I really have no idea what the risk premium is. Because the standard error on that estimate is 8.85%. Which means it could be plus 10 or minus 20. So you can already see, even if you go back 80 years, it sounds like a lot of history. your historical averages, we're talking about the 3.88% comes to the standard error of about 2.4%. Your true risk premium could be 6, it could be 8, it could be 1, it could be 0.5%. In fact, here's a simple way in which to estimate the standard error in your risk premium. Take the annualized standard deviation in U.S. equities has been about 20%. Divide that by the square root of the number of years of data that you have in your sample. Roughly speaking, that's your standard error. So 20% divided by the square root of 80 gives you about 2.26%. That's what you saw the standard error on the previous page. But here's an even scarier thought. You know what the VIX is? The VIX vapor up that you drop on your chest. This is the VIX. It's a volatility index, right? Sometime later in this class, I'll show you what that index did between September. It's basically an implied standard deviation for equities built into options. What did I say the historical number for stocks was? 20%, right? In October of 2008. You know what the implied standard deviation on equities was? 20% is a historical number. It got up to 80%. Think of the consequences of standard errors, right? If you needed 150 years of data with the old equity markets, you now need 500 years of data before you can even make a judgment on equity risk premium, because as they get more volatile, averages mean less and less. I historically, in corporate finance, remember I gave you the choice, I said go with historical premiums. This year, for the first time ever that I've taught corporate finance, I'm going to push people away from historical premiums. There are things I will talk about as we go through this class that I've changed on because of the crisis. One of the things I've changed on is the use of historical averages for risk premiums, because with the volatility markets, 80 years to me sounds like just a snapshot in history. The standard error is too large to come up with a risk premium with historical data, and it's moving in the wrong direction. It's completely counterintuitive. So historical risk premiums, anybody who's using it is going to run into an issue of this noise. Here's the other issue. Many of these historical risk premiums kind of stay frozen in time because if they don't update, they don't have a problem. It's one of those, if I don't see it, it's not there. So it's kind of frozen, 2002, 2003. And they all use US data. But there's a problem. There's a survivorship bias here. You see what the survivorship bias was? What is the most successful equity market of the 20th century? Not the 21st, the 20th century. It was the US market. We picked the most successful market of the 20th century. We've come up with a risk premium from that market, and we're saying that's the risk premium you're going to earn investing in equities for the next 100 years. You know what we'd really like to know what the risk to come up with a historical risk premium? We'd like to know how much money you'd have made if in 1901 you'd gone out and picked the 20 largest equity markets in the globe and put your money across all 20. Because some of your money would have gone to the Austrian market. Some might have gone to Argentina, and some might have gone. You had no way in 1901 of knowing who the winners were going to be and who the losers were going to be, right? Your composite equity risk premium across the market is really a better measure of a historical risk premium than picking the winner market and saying, that's it. Now, until about 5 or 6 years ago, I could talk about this only in the abstract, but there's a great book that came out, which gets updated. In fact, the website, I'll give you the link to the website, that was written by a couple of guys at the London Business School. And what they did was exactly what I said. They went back and looked at risk premiums, not just in the US market or just the UK market, across markets. They actually, so the update you see here is the update through, I think, 2006. They're a little late in updating numbers. Right? So this is across markets. So you can already see that if you invest in the Danish market, you're kind of sunk. But if you want an equity risk premium, you really want an average across the markets, not in any one market, right? The average they came up with as a composite average was about 4% across all markets. But it'll be interesting to see how those numbers collectively change as you bring in 2008 numbers, because every one of those premiums is probably going to be smaller. There isn't a single market that did well in 2008. They all lost money, 20, 30, 35%. But it's a better way. If you're going to use a historical risk premium, at least look across multiple markets. Don't just focus on one market and say, that's my risk premium. Any questions on risk premiums? Yes?
But you seem to indicate a second ago that there was 7% equity risk premium. Where's that
It's not a historical premium. In fact, that's a good setup. Malik asked a question. That's a good setup question for the next class. I just made up a number, right? 7%. I pulled it out of my, you know what. But we will actually come back and talk about that, because obviously, if I'm going to come up with a number other than a historical risk premium, I can't say, just trust me, I know what the number is. Okay? We'll have to come up with a more concrete way. We'll